Greetings, my name's Samuel, and together with Nora, Omang, Shubham, and Kushal, we are Group 1. We're going to be presenting a financial study case on Canadian Pacific Kansas City Limited and Canadian National Railway Company.
My name is Kushal Patel. Today I will be discussing the financial performance of Canadian Pacific Kansas City Limited over the past 3 years. To give some background information about this company, CPKC is one of North America's leading freight railway companies, headquartered located in Calgary, Alberta. This company recently took a major step by merging with Kansas Kansas City Southern in 2023. This merger created a single rail network spanning Canada, US, and Mexico, greatly enhancing CPKC's capacity and competitive position across North America. In our financial analysis, we examined several different ratios uh, to understand CPKC is managing these resources. Liquidity ratio, specifically current ratio and quick ratio, which help assess CPKC's short-term financial health, showing how easily the company can meet its immediate obligations. Debt management ratio, like the debt equity ratio and cash flow to total liabilities, which highlight the CPKC's financial leverage and its ability to handle long-term debt. Lastly, we look profitability ratios, including the gross margin and net profit margin, which reveals how effectively CPKC is managing costs to generate the profit. Through this ratio, the analysis evaluates debt management and profitability trends essential for investment and financial decision making. And in this slide, we can see the graph and the different ratio. Uh, Starting with the liquidity ratio, CPKC's current ratio declined from 0.53 in 2021 to 0.43 in 2023, and its quick ratio fell from 0.15 to 0.10 over the same period. This trend suggests that CPKC's liquidity has weakened, meaning it has immediate capacity to cover short-term obligations. This decrease could raise concern about the company's short-term solvency. Now, looking to debt and cash flow ratios, we observe an increase in the debt to equity ratio from 0.88 to 1.2, indicating that CPKC has taken on more debt uh, to its equity. This higher leverage can lead to greater financial risk, especially if cash flow becomes tight. Additionally, the cash flow to total liability ratio declined slightly from 0.13 to 0.12. This reduction means there is a less cash flow available relative to total liabilities, which could become a concern for the company's debt coverage if this trend persists. Moving to profitability ratios, uh, CPKC's gross profit margin remained steady around 51%, suggesting stable and effective cost management. More and the net profit margin rose from 24% to 40%, reflecting significantly improved cost efficiency and stronger overall profitability. Uh, and overall uh, insight, while CPKC demonstrate strong profitability, its liquidity and raising debt level indicates a need for careful management of cash flow and leverage to ensure sustainable growth.
Good morning, Professor. I am Shubham. Today I am going to talk about Canadian National Railway, or CN for short. CN is a big railway company that operates in Canada and the United States. It was started back in 1919. and is based in Montreal, Canada. Originally owned by the government, CN was sold to private owners in 1995, which was a big change for the company. Now it has a vast network of about 29 kilometers of railway tracks. CN transports a lot of different things like cars, grains, and energy products. The company is led by CEO Tracy Robinson and CFO Ghislaine Howe, who focus on making CN efficient and environmentally friendly by investing in new techniques. Let's dive into CN's financial performance from 2021 to 2023. Our analysis, based on several key financial ratios, reveals both strengths and areas of concern. The current ratio, an indicator of liquidity, has decreased from 1.10 in 2021 to 0.61 in 2023, suggesting a tightening liquidity that could pose challenges in meeting short-term obligations. Similarly, the quick ratio has dropped from 0.46 to 0.23, indicating diminished capacity to cover immediate liabilities without selling inventory. Moreover, the debt to equity ratio increased from 1.58 in 2021 to 2.16 in 2023, reflecting a higher reliance on debt financing. While this can be enhanced financial leverage, it also introduces greater risk, especially in volatile economic conditions. The operating cash flow to total liabilities ratio also showed a decline from 0.19 in 2021 to 0.16 in 2023, which could signal difficulties in generating sufficient cash flow to cover liabilities. Despite these challenges, CN has maintained a great gross profit margin consistently around 39% to 40%, demonstrating effective cost control and pricing strategies. The net profit margin has experienced some fluctuations but remained relatively stable, with a slight recovery to 33% in 2023 from a low of 30% in 2022. In conclusion, while Canadian National Railway shows strong profitability and gross margin, it faces significant challenges with decreasing liquidity and increasing leverage. These financial insights highlight the need for careful management and strategic planning in sustain CN's long-term growth and stability.
Okay, so today we are comparing two major players in the Canadian railway industry, Canadian National Railway, CN, and Canadian Pacific Kansas City, CK, CPKC. So talking about the liquidity ratios about these companies, we analyze the current and quick ratios which measure a company's short-term financial health. Both companies showed a decline in liquidity from 2021 to 2023, indicating potential challenges in meeting short-term obligations. CN's current ratio fell from 1.10 to 0.61, and CPKC's declined from 0.53 to 0.43. The industry standard is between zero point 0.5 and 1.0, so they are within the range, but on the lower end. Talking about the debt to equity ratio, this ratio reflects financial risk. CN's debt to equity rose significantly, reaching 2.16 by 2023, while CPKC maintained a more conservative range, ending at 1.02. This means CN is more leveraged and carries a higher financial risk than CPKC. So, talking about profitability ratios and investment analysis, gross profit and net profit margins, we evaluated the profitability of each company. CPKC has consistently maintained a higher gross profit margin around 51%, which is above the industry's average of 40 to 50%. For net profit margin, CPKC rose to 40% in 2023, reflecting excellent cost control. CN's net profit margin remained stable between 30 to 34%, showing steady but slightly lowered profitability. About the investment recommendations, Based on these insights, we recommend CPKC as more attractive investment while both companies exhibit strengths. CPKC's better profitability and lower financial risk through debt control make it a preferable choice in long-term investment portfolio. To conclude it, in summary, both CN and CPKC show strong industry positioning, but each faces liquidity challenges. However, CPKC stability and debt management and higher profitability margin makes it the better choice for investors seeking reliability and growth potential. Thank you.
Good evening. I'm Samuel, and today I'm going to be talking about the heart of business sustainability, which is cash flow analysis for our main company, which is Canada Pacific Kansas City Limited. Okay, well, starting with the operating cash flow, we can see that it has been consistent throughout the last 4 years. It shows an increasing moving average, again pointing to good financial health and stability in the company as a whole. The managerial discussion and analysis confirms that the company is solvent and that is covering for both short-term and long-term debt instruments. This is consistent with our analysis of the solvency ratios, but it contrasts with what we found in the liquidity ratio analysis. The company has been consistently investing in new assets in the said past 4 years with a very significant 13, almost $14 billion investment in 2021. Similarly, on the same year, the company got almost $10 billion on financing, which furtherly points to the growth and overall financial stability of the company. Now we'll proceed with the central tendency and dispersion analysis of said cash flows. Central tendency analysis, which in here comprises the mean and the median, is going to reveal to us the typical cash flow value. And from an investor's perspective, it's going to help to gauge to the average or the expected financial health of the company statistically. And the dispersion analysis is going to show us both stability and risk because it's key when it comes to evaluating consistency. Now, it's worth analyzing the skewness pattern that all three types of cash flows show. We're going to start with the operating cash flow, which has a value of 0.52. On statistical standards, that is a this is to be interpreted as a low level of skewness, which points to a mostly symmetrical distribution. Now, this is important because it means that both the mean and the median were not affected as much by outliers or measures, observations that deviate significantly from the mean. Now, however, when we talk about investing cash flows and the financing cash flows, due to the outliers that were described in 2021 in both of these cash flows, um, the skewness values have been greater, well, exceeding 1 in the case of the financing cash flow and exceeding -1 in the case of the investing cash flow. This is to be interpreted as a significantly high skewness level, which needs to be taken into the account if we're looking at those central tendency measures to make a potential financial decision when it comes to investment portfolio. A time series analysis is also displayed to graphically represent the evolution of said cash flows across time.
Right. Now we're talking about Canadian National Railway Company. Regarding the cash flow analysis, the first thing we need to notice is about the operating cash flow showing positive values. What this means is an inflow of money, which means to healthy and efficient operation, the company can cover all the expenses and generate cash from all its operation. Now, regarding the investing cash flow shows a negative value. This isn't necessarily bad. What missing here is that the company is investing in purchasing assets or expanding its operation. This was confirmed later in the company's documentation. Then the financing cash flow also shows a negative value. The translation of this is it's possibly because of loan and the repurchase of shares and dividend payments. Okay? Now going over with the next slide. The previous slide gave us three key points to know about this stage of this company. The first one is efficient operations and sales growth, recurring capital investments, and a priority to shareholders with the repurchase of shares and dividend payments. This is a company in a matureness stage. Also, it's important to notice that the central tendency and the spread analysis shows low skewness, which points out to financial relevant measurements. So, as a summary, yes, the company is in a matureness stage.
We conclude from the present analysis that the main company is showing a very solvency when based on ratio analysis, even though it is slightly less liquid than the competitor. But the difference doesn't carry high significance. Both companies generate net profit at almost the same level, even though the main company generates considerably more gross profit, which is if accounting for costs and interests, and if those were to be optimized, our main company could outperform the competitor in terms of net profit. The enormous cash flows in 2021 of our main company, both in investing activities and in financing, point towards the fact that the company it's in its maturity phase, uh, looking to invest and continue increasing their profitability. All of this led us to make the decision that if we were to invest in one of these two companies, we would choose the main company, Canadian Pacific Kansas City Limited. Thank you for your attention.